How did legendary spread traders make millions? Imagine turning small differences in prices into millions of dollars. That's exactly what some of the most successful spread traders did. They mastered the art of spotting tiny gaps between related commodities or financial instruments. Spread trading involves buying one asset and selling a similar one at the same time. The goal is to profit from the change in the price gap, not the overall market direction. For example, a trader might buy a December crude oil contract and sell a January contract. If the price difference between these two contracts shifts in their favor, they close the trade with a profit. This approach relies on understanding how related assets move relative to each other. One famous example is in natural gas markets. In 2006, a hedge fund made nearly $1 billion by betting that the wide price gap between natural gas contracts for different months would narrow. They saw that the difference was unusually large and believed it would decrease. When it did, they made a huge profit. Successful spread traders use both technical analysis, which studies charts and patterns, and fundamental analysis, which looks at supply, demand, weather, and geopolitical factors. Combining these helps them find mispricings before others do. Risk management is key. Since spread trades are often hedged, they tend to carry less risk than outright bets on market direction. Still, unexpected events like sudden supply disruptions can cause losses. Smart traders set stop-loss orders and carefully size their positions to limit potential damage. For example, they might buy a grain futures contract and sell another if they believe the relative value will change. If their analysis is correct, the spread narrows and they profit. Legendary traders made millions by focusing on these price differences. They used disciplined analysis, timely actions, and solid risk controls. Their success shows that understanding the relationships between related commodities and acting on those insights can lead to consistent profits. Spread trading is not just about guessing market direction. It's about reading the subtle shifts in the relationship between assets and acting quickly when opportunities appear.